Hi, everyone. I wanted to talk today about something interesting, something new, and something relatively popular. It's called private credit. Hi, I'm Kwesi Baye with Montclair Amherst, a consultancy dedicated to helping small businesses and individuals go to the next level. So, what is private credit? Think of lending. Usually, banks do that. They have a strict structure, they have underwriting standards, they have all of those capabilities to lend out money. And they usually lend it based off of deposits. However, not all lending structures work like that. And due to the financial crisis, lending got more restricted. Lending lending has to meet multiple requirements in order to not be as risky, and banks have taken a risk off approach towards most loans. So, in their place, private credit took place. Private credit, in their place, private credit took over and took over that lending function. So, how does private credit work? So, you have this investor, they want to have return on capital. They give their money to this private credit investor. And the private credit investor collects money from a pool of capital and uses that pool of capital to make loans. They typically loan to private equity backed companies or they loan to other companies, but they're usually not the prime borrowers that would usually go to the strict lenders or the best bank lenders or raise a bond. They're usually the subprime lenders. And this makes it more complicated because there's more due diligence that is necessary for it to for it to work. In a way, you can provide private credit transactions if you do microcredit. You loan to a friend or family for equipment or supplies, or you loan to a new business owner, or you loan to someone with the expectation that they pay back in return plus interest. But whether you loan to an individual or a company or a multinational or any form of lending, you have to essentially make sure that you are doing your due diligence so you get paid back with interest, you follow the rules, and you stay out of jail. So, in order to follow the rules, right, in order to get your capital back, you have to do some underwriting standards, and I'll explain some of the basic stuff. First of all, you need to gauge their income. You have to see if they have enough revenue to meet their expenses plus your obligation. This is done by looking at a few bank statements that they have and looking at all transactions they have. You have to thoroughly vet them and make sure they're not hiding any income from you or hiding any expenses from you. If they have any unusual items on their expense account, you should not lend to them because it's very risky unless you know what you're doing. In addition to that, you need to have um, you need to have collateral. So you need to know if they don't pay back, what is your recourse? So what do you have that would essentially guarantee you get paid back with interest even in the case where they don't pay? This can be materials they have. This could be cars. This could be houses. This could be anything. But you need to know that the collateral is valuable enough to pay back the loan. You need to know that it isn't pledged to multiple lenders, and that takes critical due diligence. And you need to make sure that these people are essentially honest with their collateral, that it's valued where it is, that it's not pledged to multiple lenders, and that it doesn't depreciate higher than you expect it to depreciate. This takes a bunch of work, and in order to do this part correctly, you need to be good at valuing materials, good at valuing things of value, good at valuing collateral, and understanding what happens in case of stress scenarios. In addition to that, you need to know the history of repayment. So, how have they repaid loans in the past? Have they missed any loans? Have they missed any payments? Are they paying late? What sort of history do they have with paying back their obligations? You need to see that using a history of transactions, looking for uh, things sent to collections, looking for their credit score in the case of individuals, or their bond rating in case of corporations. Often you don't know what you don't know, and often they not everything is out in the open. So you have to do a lot of digging to understand it. As you see, private credit could get very complicated, and there was a recent bankruptcy in that occurred for an auto parts supplier that actually had a situation with private credit and other lenders that had collateral being pledged to multiple lenders. Fraud, there was fraud due to invoices being faked. So invoices were being used as collateral that didn't exist. And pretty much private credit got caught with their pants down. You do not want to be in that situation if you are lending to people. And if you want to learn more about lending and participating in this, you have to be very careful. In order to do this correctly, you need to have due diligence. You need to have good underwriting standards, and you need to prepare for losses even in good times. So, if you want to do private credit, you can consult with me. Contact me using info@montclairamherst.com, or look at our website, look at our social media, and contact me through there. Thank you.